All right, I'm going to start off the weekend report. We're going to take a look at what has transpired so far. I warned people that this was likely to be a very powerful initial first daily cycle, and it's not unusual for a first daily cycle to recover all of the ICL losses before that first cycle tops. Now, originally, my feeling was is that we would probably run into resistance here at this 2800 to 2815 zone, and that would give us our first daily cycle top. But I'm going to show you a few charts once we get done with this one that may indicate that we could blow through this resistance level as well. So we'll start off and I'll look at every one of these resistance levels that we've gone through, and really the only one that provided any pause has been the 200-day moving average, and that wasn't much. So to start with, we've got this the lower zone of this consolidation box right here at about 2600. All right, so here I've drawn the line in, and you can see price paused for 4 days and then pushed right through that resistance zone. So very little resistance on that initial um, spot where we could have turned back down and retested the lows. The next resistance was the 50-day moving average, and you can see this really offered no um, pause at all. We price stopped for basically one day and then blew right through it the next. Tested it a couple times and then we're off to the races again. So more or less nothing from the 50-day moving average. None of the Fibonacci retracements have really halted price at all. We've just blown through all of them with almost no effort. And as I said, I really didn't think the 200-day moving average was going to stop this first daily cycle either. This was a prime spot to create a bear trap. I think I think there's still a lot of analysts out there that are expecting a retest of the lows, and at this point, I'm becoming more and more positive that we are not going to retest this. Um, but I think a lot of people use this 200-day moving average to really load up on shorts. We get a 2-day drop, and then we blow right through it. And that's kind of what I expected was going to happen. My expectation was that we'd blow through it and it come up and test this, a bigger resistance zone here at this 2800 to 2815 level, and then maybe that's where we get our first daily cycle top. But I'm not even I'm not even 50% sure that we're gonna that's gonna stop price either. And again, I'll show you some more charts here in just a second as to why I think that might be the case. We've taken out this 200-day moving average. There's a decent chance that the 200 could now act as support. So, this first daily cycle, it may top here at 2800 to 2815, but then, it may bottom on a retest of the 200-day moving average. Now that we've broken through this, institutional traders will view the 200 as support, so we may not go back below the 200. All right, now let me show you a few charts as to why I think that we may, first off, we probably have very little chance of retesting the lows, but also some charts that may suggest that we're 2800 is not going to stop this first daily cycle either. So the advanced decline line has now made new highs, and almost invariably, every time this has happened in the past, the market eventually follows to new highs. So the advanced decline line will lead, and where it goes, the market follows. So we've got new highs here. So I think we can almost bet the farm that we're going to we're going to break out and make new bull market highs. And this was nothing more than exactly what I said it was. This is a regression to the mean multi-year cycle low. This, it came a year earlier than I expected, but that doesn't change the fact or the nature of what this was. This is not the beginning of a major multi-month, year and a half long bear market. This was just the market got stretched too far above the 200-week moving average, needed to correct, did, and now we've had one of the most powerful thrusts off of a bottom in history, and sentiment had gotten stretched at this bottom to historic degrees as well. And that is the fuel for this very strong rally that we are seeing. So new highs in the AD line, the odds are very high that we're going to new highs in the general stock market in 2019. All right, so let me show you some charts that I think may indicate that 2800 may not stop this first daily cycle either. The first chart is oil. Of course, we've got our inverse head and shoulders pattern here, and on Friday we poked briefly above the neckline. I suspect this is going to continue next week, and if oil is ready to break out above this pattern and give us that move to maybe somewhere between 62 and 65, $66. And actually, I guess if we adjust the target for the corrected neckline, the target would be more in the range of somewhere between $66 and $70 on this bottoming pattern. And at the very least, I think once we complete this breakout, then this 200-day moving average is going to act like a magnet, and I doubt that oil will take much of a pause until it at least reaches this 200-day moving average. And if oil isn't going to pause, I find it unlikely that the stock market will pause. This next chart is the semiconductor index, and the semis have led this rally once we got past the elections and started the next leg up. They led and recovered those 2000 highs, which was at about 1362. Of course, we're too late in the multi-year cycle to get a sustained breakout, and that's why we had this long sideways consolidation pattern and then the breakdown into the multi-year cycle low. But the semis recovered their consolidation box very quickly, broke out through the upper part of the box again with took very little effort to break through this consolidation box, so that the leading sector is leading again, and it is performing very strong. And there really isn't a whole lot of resistance between here and these all-time highs. Let me back this chart up just a little bit. All right, so we've got the all-time highs here at about 1460. Got a little resistance, maybe a little above 1400, somewhere around 1410 and 1420. Some more resistance at 1440, and then at 1460. But there's just not a whole lot that it's going to, looks like it's going to stop this chart until we at least get above 1400. So again, this is a chart that suggests it has more upside to go before really running into any serious trouble. And if the semis continue to lead, I don't foresee a top in the stock market until the semis are done and ready to take a breather. And this chart doesn't tell me that they're ready to pull back just yet. All right, another sector that needs to lead this market higher is biotech. And on Friday, biotech has made its first attempt to break out of this consolidation box. If this holds, we've got a little resistance here at the 200-day moving average, but as we've seen on a lot of charts, the 200 hasn't really provided much resistance at all to price in any of these markets, indexes or sectors. So Pretty long basing phase here, breakout today. I kind of doubt that the 200 is going to slow down the biotechs much either. And if that's the case, then once we get through the 200, then again, these all-time highs are going to start acting like a magnet, pulling price higher. Moving on to the Dow, again, 2,300, almost no resistance. One quick back test of that. That was on the day Apple pre-announced, but recovered the very next day. So, almost no resistance at 23,000. A pullback for 2 days at 24,000. 25,000, again, the 200-day moving average, and just almost no resistance to the move at that point. 2,600 is going to be acting like a magnet here. If we blow through 2,600, then again, we've got these all-time highs acting as a magnet, pulling price higher. So we've got about 120 points to go, I guess, to get through 26,000. And if the Dow gets through that, then we may turn on the magnet, and we could very easily see this get to test these all-time highs before this first daily cycle tops. Here we've got the housing index, which on Friday broke out above the 200-day moving average. Again, not a lot of resistance if this breakout holds until we get up above 300, somewhere between 310 and 320. Definitely some more potential here in the housing sector. The banks on Friday also look like they're trying to break out of a sideways basing pattern for the last couple weeks. So, the bottom line is we've got a lot of sectors that are just now breaking through some resistance levels, namely the 200-day moving average. And other than the S&P with that resistance zone at 2,800, a lot of these sectors don't appear to have a whole lot of resistance ahead of them for a while. So if these sectors keep powering higher, then you'd have to think that the S&P is going to follow, and we could just blow through that 2,800 level with maybe just another one of these quick 2-day pullbacks. So next I'm going to move to the baby bull rally in gold in 2016 and just show you what happened when another asset, when gold, came out of a multi-year cycle low at which some really extreme sentiment levels were generated, because I think a lot of people are just assuming. Well, first off, I think at least 90 to 95% of analysts were all expecting the stock market's going to retest the lows, and that theory is starting to go out the window very quickly. So now I think a lot of people are banking on 2,800 to turn the market back down. And so, I mean, we've already seen a lot of people, take some major losses, especially if they're playing with the inverse funds, trying to pick a top to this rally. The bears that may have made money on the way down, most of those people have given back all of their gains at this point. And I've mentioned before many times in the past that it's just I've always found it very difficult to make money on the short side, and this is one of the reasons why. Markets just go down differently than they go up, and sometimes bottoms can be an event and a violent event, and depending on how extreme that sentiment is at the bottom, you can just get one of these exceptionally powerful rallies that that the bears that got locked into this into a bear market mentality, they are unable to flip the switch over to bullish strategies, and so they keep trying to pick a top, or they just keep hanging on to their shorts, and then ultimately they give back all of their gains that they made on the short side. And I'm seeing this happen with a lot of traders in the challenge. The few that did make money on the short side, almost invariably all of them have given back all or most of their gains because they held on too long. They bought into the bear market story, and I don't think there's any story there. I think this was nothing more than a regression to the mean correction, not the beginning of some serious economic collapse. All right, so as I said, I'm going to show you what happened during the baby bull. And at this bottom, of course, we had 4 years of bear market. Sentiment was about as depressed as it has ever been. And as gold came out of this final bear market bottom, we get the retest right here. And then we start, I guess the actual count would start right here, as this was the lowest low. But if we just count from the retest until we get something that qualifies as, at least a daily cycle low, and keep in mind at this point, the daily cycles were still running, 25 to let's say 35 days on average. So, people could have been expecting a daily cycle low as early as, early February. But the first real daily cycle low didn't start until here, well into March. And it was 57 days from this retest of the low to this top right here. And then we get a pullback that qualifies as a daily cycle decline. And so I'm seeing, at least cycle analysts anyway, a lot of people are just assuming that we're going to get a normal 35 to 40 day cycle in the stock market. And if I remember right, I think we were on day either 35 or 36 on Friday. So a lot of people are using cycles and anticipating a move down into a cycle low in the normal timing band. But what is not normal, I'll go back to the stock market now. I just wanted to show you what can happen coming out of one of these lows, that cycles can get extremely stretched as they are driven by extreme sentiment levels at these bottoms that can prevent a cycle from moving down into a daily cycle low when it would normally do so, just simply because there's so much fuel built up from the sentiment extremes at one of these multi-year cycle lows. So it's not unusual to get a stretch cycle during a first daily cycle when you get something like this with an extreme sentiment. So let me move back to the stock market. All right, so I did count the days here. Friday was day 35. So, like I said, a lot of people are expecting this to roll over and give us our daily cycle low in the normal, let's say 40-day timing band. And I'm saying that we generated such extremes at this bottom that this could very well trigger a long cycle that runs, 50 days or more. And we're only on day 35 here, so we could potentially, maybe even have 3 or 4 more weeks to go before this daily cycle tops. Now, if you caught the bottom here and you've rode this up and you've made some really nice gains, by all means, I would take some profits. Maybe you just keep a small core position, but at 2,800. Somewhere between 2,800 and 2,815, I would take some profits and then see if we break through. If we get a little pullback, and then in the next day or two, we break through to 2,825, then I think you can throw out the normal timing band scenario. And at that point, I think these all-time highs would become a magnet, and we're probably going to head to that level before the daily cycle tops. So, maybe take out a little insurance at this level or take some profits, but be ready to put that position right back on if we go through that fairly quickly. All right, so it looks to me like gold is trying to break out of this flag pattern. And, you know, I said in some of my recent reports that if gold lost this $1,300 level, then you probably needed to get out of Dodge because at that point it probably meant that an intermediate decline had begun and gold was going to at least come back down and test this 200-day moving average. But it doesn't look like that's happening. It looks like gold wants to break upwards out of the flag. And if that's the case, then once we get past this high here, the cycle would be likely to right translate, and we're probably going to test that 1360 to 1370 level that's kind of contained this 3-year consolidation. So let me widen the chart out a bit. All right, so here we've got the flag, and we've got this top that is just contained price for since 2016, since the baby bull, basically between 1360 and let's just call it 1380. I think it was 1377 was the actual price. But every time we get to this level, the sellers come in and they stop the advance. But I think there's a very good chance that this flag pattern is breaking upwards. And if it is, then we're probably going to test this level again. And this, to me anyway, it looks like we're forming a cup. And if we can get up to this 1370 level again, then maybe that's where we get the next intermediate cycle low that forms the handle to this cup, and then we get a breakout later in 2019. And finally, get out of this basing pattern that we've been in and maybe run up to test a 1550 sometime in 2019. That would be the breakdown zone where the bear market really began in earnest. So I had noted in maybe it was either Wednesday or Thursday's report that let me go back to the daily chart. Okay, so I noted, I guess it was in Thursday's report, that you could probably go ahead and put your, even if you're comfortable with the leverage, you could put your leverage trades back on, and then your stop would be right below this low, because I think this is going to turn out to be a half cycle low. And if gold comes back down and drops below this low, then we're probably dealing with a daily cycle that's topped. And at that point, you want to get out and just wait for the next ICL. And you'll lose a little money if we come down and hit this. Your stops will get hit, and if you bought Friday morning, you'll lose a little bit, but you're not going to lose a drastic amount. Nothing that can't be recovered easily if gold were to come back down, give us an ICL down here around 1250. If you could get in somewhere around there, you should easily recover any losses you might have, which would be small if gold were to reverse and take out this low and trip your stop. You'll take a small loss, but nothing that couldn't be recovered in a day or 2 days if you can catch the bottom of an ICL, which is probably what it would mean if gold comes back down and takes out this low right here. All right, finally, I'm going to take a look at the miners, and since July, I guess it was, I'd called attention to this coil pattern that formed on the monthly charts in the miners, and as I've explained many times in the past, about 70 to 75% of the time, the initial move out of a coil tends to be a false move, and it's usually reversed pretty quickly, and it leads to a much more powerful and much more durable move in the other direction. And this is playing out textbook. We've got the breakdown from the coil. Again, they tend to be violent when the break does occur, whether it's up or down, produces a violent move. That's exactly what happened here. We had 2 months of very nasty losses, and then we have 1 month where we find our bottom and stabilize, and then the move in the opposite direction starts to unfold. And as you can see, this is we've already regained the coil zone right here, and we're just about to push through it. If we get through 23, we'll push through this coil zone. And my guess is that gold is probably going to, the breakout from the flag is probably going to succeed. Gold is probably going to get back up and test that 1360, 1370 level over the next month or so. And when it does, I think the mining stocks are going to test this upper zone of this consolidation box. And let me draw that in. All right. So, for just a year and a half, almost 2 years, the miners were just stuck bouncing back and forth in this consolidation box. We get the coil and the breakdown out of the box, and then the coil reverses. We quickly re-enter the box, which is a very bullish sign. And last month, briefly tried to push back down through the bottom of the box, which would have been very bearish. But by the end of the month, the miners had closed well back into the box. So I think there's just nothing bearish about this look to me. I think the coil pattern is playing out as they usually do. And before the end of February, I don't think, let's call it by the middle of March anyway, I think it's not unreasonable that the miners could test this upper zone of this consolidation box somewhere around, let's call it $25.50 to $26 on GDX. And then at that point, I would look for maybe the handle of that cup and handle pattern in gold and a correction again back down into the box. So I'm not sure we're going to break out of this consolidation box on the first try, but I do think we're going to break out sometime in 2019, and we're going to at least test these baby bull highs. All right, that's it for the weekend report. I tried to keep this one short, didn't succeed as usual. I guess maybe I need to find a way to talk faster on these weekend reports. All right, so Monday's a holiday, so I guess we'll go back to work on Tuesday.